Good morning. First of all, I'd like to thank you all to be here with me. And goes to show how wonderfully everybody is seeking to improve. Trading is a profession which really requires continuous improvement. After years and years also, I see the only thing which is work. What I see as work is what are the steps I take daily to improve myself. On your right hand side, there's a panel. You can use that to ask questions. A small introduction, a little bit about myself. My name is Mohak Pachisia. I'm a chartered market technician. I've also completed 2 levels of the Chartered Financial Analyst course. But all these degrees are just for you to be in front of me. What really matters is what you do on the screen in the markets. Nothing else matters. It is very difficult for people to digest that it is not perfection which you require. It is actually imperfection and the love for imperfection which you require in markets. So over the years, apart from my higher studies, education markets, I've been a trader for about 8 years now. In the last 2 to 3 years, I've given a lot of seminars. I've gone and taught a lot of places. There have been seminars, there have been webinars. I've taught even professional traders. They've been trained by me. A lot of my students have become professional full-time traders. And in this entire journey, I have, there are a lot of common denominators amongst people. The common denominator with regards to what they need, what are the points of improvement they're looking for, what are the common problems which are there. And more or less now, these days, you get to know, like I get to know what stage of trading is somebody in. So long story short, in this entire journey, now I've come to a point where every week we're doing a free webinar and we're taking up some topic. And beside the paid course which is there, the paid course is Technically Sorted, that's the name. It's a course in technical analysis and trading. We do these free webinars and we touch upon small points and small topics which can be very crucial catalysts for your long-term improvement. So thank you again for being here with me today. Today we're going to talk about trade execution, like purely trade execution. Till now, I don't know how many people must have thought how important it is as a topic to be picked up and taught. Trade execution seems like there would be some, something so easy. What is trade execution after all? It is about entering a trade and exiting a trade. But it is when you actually go and repeatedly take a lot of trades, that time you understand that there is something which is special about the execution part of it. And that execution part of it is so important that it really pulls down everything else. You may be using a simple strategy, but you may be using a very powerful execution. You may be using a very complicated strategy, but your execution is not good. A very complex, well-defined, theoretically very sound and advanced strategy, but your execution is not good. Nothing doing. You're not going to make money. As I said, it is not about what books you have read. It is not about what degrees you have done or what education you have, how well you are spoken in markets. All that matters is how well can you perform, how well you can execute. So when we speak about trade execution, we specifically speak about there are two branches which come from there. There are certain things which are related to the cognitive idea. The cognitive idea, and there are certain things related to the psychological idea. We're going to talk about both. And unlike a lot of my other webinars and YouTube videos you will see, which are full of presentation, and this will be, obviously there will be a certain level of presentation, but there will also be a lot of talking about each of the points. There's going to be a lot of interaction, so please feel free to interact with me. When I ask you a question, if you interact or participate very actively, this will help each other solve each other's problems. And somebody's solution may be a problem of someone, somebody's problem may be a solution for someone. This is how paradoxical trading can be. And this happens in magical ways. Moving on, what are the small things that we forget? The small, simple, logical things that we tend to forget when speaking of trade execution. The first thing, it is not about you being right or wrong, or correct or incorrect, about the direction of a move. It is never about that. There is something which may be really trending and you would want to jump on it. And you make money and you get out. There may be some other day where something is like nearly going down. You just jump, sell, you get in, you get out, make money. And there'll be another day where you get in, but you hardly make any money and you get out. The point is that whatever strategy which you're employing has to be in line with the magnitude of the move. And when these habits of getting in and getting out with the flow go to a peak, there may be just one accident, one place at the wrong time you took the entry, and you never thought about what is the magnitude of the move I'm looking for. How much am I looking for to make profit from? How much am I looking for as estimates of the move? It is not about me coming and telling you, I see that markets may go up tomorrow by 100 points. If I don't add that 100 points part to it, it makes far less sense if I tell just that markets are going to go up. If I don't, we are talking about estimates of movement. We are not just talking about directions. Whenever we trade, a lot of people, especially newcomers, have this idea that it is just about market is going up or market is going down. This is just a very small part of it. The major part of it really comes when we are looking for a trading design. What do I mean by trade design? A trade design is where something is aligned with a certain risk to reward ratio. At that moment, if the reward, as in the magnitude of the move you're looking to book out profits from in your direction of the trade, that is the reward. If that reward significantly outweighs the risk, which is the movement of the stop loss or the opposite direction of your trade, if the reward outweighs the risk, it makes complete sense to take that trade. If the reward does not outweigh the risk, mathematically it makes no sense of taking that trade. So people really need to not forget these little things. First of them being the magnitude of the move. The second is people don't take it as a business opportunity. I tell this to my students that it is easy, if you want to go and build open a company, you want to start a company, it is easy, right? You just need to get your current account in a bank done, you need to get your trade licenses, you need to get your stamp papers and a few papers here and there. You can start after some documentation. That is your company, or that is your firm, partnership firm or whatever. What is difficult is to build a business out of it. That is long term. Similarly, it's easy to open a trading account, put some money in it, and think of doing something about it. It is very easy. To build an entire career out of trading, there are a lot of steps. It is a long-term process, and it is difficult. It is full of struggles, but that struggle is really worth it, worth the reward. So if I take a business, suppose I buy and sell something. Suppose I buy and sell books. So if I buy and sell books, I'm buying and selling, right? And whenever I buy, I ask for the transporter or whoever to get those books to me. I have to take care of how the books are going to come, the number of books that I have to pay for as advance before they come, the number of books I will get paid for in advance before they come. I have to look at debtors, creditors. I have to look at how many books at the time am I buying. Am I making profits? Am I redeploying my profits so that I can buy and sell more books next time? So if I start a book business with 10 lakh rupees and I build it up to 10 crore rupees, it is not going to be out of just one transaction and one consignment. It is going to be a series of things, a series of opportunities of business transactions and business deals. Similarly, when you're taking one trade, you can look at it as one business opportunity. People don't generally do that. They are either on this sitting on this myth that there would be one big trade which would change their life forever, one big trade that could make them a millionaire, and all sorts of wrong things happen because of it. They over leverage behind that one trade. They don't think about what they're exactly doing. And it is not easy for me to get into that head helmet of yours. It is difficult. Why? Because I've gone through all those things, but I've forgotten about how to do all those things. It is extremely important for you to understand this. For me, over leveraging is not a problem because I don't over leverage. I've developed the habit. But when people come to me, the idea is that somebody spoke about, a person who was investing, say, 50 lakh rupees. All he wanted that he could get some idea of some stock idea that would go up. So there was a person who is known to me. He advised him something. And the person went and bought, shares worth 50 lakh rupees entirely. It makes no sense at all to do so. You see, in the end, if you're risking on a business opportunity, your entire capital, you have all the chances of that capital being eroded by a large extent. So how many of us take it as a series of trades? How many of us don't take it as a be all and end all of your life? One trade is not the be all and end all of your life. You need to take it as a series of opportunities. Within that, we have to understand the probability. We'll come to that later. Point number 3. How many of us look at the business risk? So, when you look at the business risk, you automatically divide the risk. So, in that case, we kind of mingle it with point number 2. That is that if you take it as a series of business opportunities and one trade as one business opportunity or one business project, then what you can do is you can divide your capital and you can risk one by one, or at a time 2 or 3 projects or 2 or 3 trades at a time, how much ever you can handle. So you need to understand that the business risk part of it is extremely crucial. How would you understand that? Understanding of this comes from a probability mindset. Believe me, the most remarkable people in other professions I have met, the most intelligent, accomplished, and appreciated by all of their colleagues, the most remarkable people I have met in other professions other than trading, they have come out to be the worst traders I have ever seen. Why? Because they come from a perfectionist mentality. Amir Khan would find it difficult too. So you don't if you come from a perfectionist mentality, you can be very disciplined. You can be very good at what you do. But that perfectionist mentality will never make you understand that you can go wrong, and that is always about a probability. When it is always about a probability, you understand that there is a risk involved, and you understand that risk has something to do with your capital erosion and something to do with your capital exposure. So I come and tell you, I'm going to buy 20 lots of Nifty and I'm going to make 20 points on it. And so 20 into 75 into 20 again. So that's about 1.5 lakh rupees. Am I right? 75 into 20. 20 points of Nifty into 20 lots. So 400 into 75. I'm going to make some 30,000 rupees. 3 lakh rupees, sorry, 3 lakh rupees, yes. I'm going to make 3 lakh rupees. If I come and tell you this, or if I come and tell you, all I'm going to do is, I'm going to buy 4 lots of Nifty, and I will make it a very long-term trade, because I see that these patterns are happening. I'll grab 1,000 points on the 300 quantity of Nifty. I have barely 4 lots, and I'm ready to lose 300 points on it. I'm going to make 1,000 points on it. Over here, what I'm trying to say, the risk exposure over here in the second case is less, because I'm having only 4 lots with me. Over there, I'm having 20 lots. What I may be playing for, what my stop loss may be, what my targets may be exactly the same. But my risk exposure is different. So when we look at business risk, we look at it in 2 ways. One is the risk exposure. So a lot of people who expect a small move. So there may be one person who may be going one fine day for scalping at 20 points, 15 points from Nifty. And all you get to know is at the end of the day, he was not just topped out on his trade, but there was an extra slippage of 10-15 points. So his stop loss was 10 points and he had an extra slippage of 10 to 15 points. And he was on good leverage. He had those 30 lots, 20 lots. The risk exposure, because you never know what can happen. There is a magnitude of move which I can calculate, okay, fine, that this is the decent level of slippage I can expect over here. So if my stop loss is say 100 points or 80 points or 50 points, if I lose another 5 points in slippage, not a problem. When my stop loss is 10 points and I lose another 5 points, it is a big problem. If my targets are about 150, 200 points, if I make only 130 points, it's okay. But there I can, there's a scope of losing out that last 20 points. There's a scope for me to react to the price. So the business risk in terms of exposure is not the same proportion as the business risk in terms of your stop loss and targets. People don't understand this. This is one of the major problems people have in trade execution. I'll come to how you can use leverage in your advantage. I'll come to that. It's going to be a beautiful thing because see, it is all about a shift. I have myself taken that shift. I have seen other people making that shift. And when you make that shift, that space is completely different. You're operating from a mind space where you're completely in the form, in the zone. Point number 4, the last point. How many of us look at the risk reward ratio? risk to reward ratio. Now here I would like to talk about the fact that technical strategies, what are they there for, and why they don't look at the risk reward ratio. There's a flip side to it. Some people look too much at the risk reward ratio and they end up taking the bad quality trades. I'm repeating these lines, you can make this. Some people take, you can make this as a note, write in big block letters, that some people Alright, so there was a small glitch, no problem, no problem. If you can hear me now, please raise your hands. Great. So, great. So, we'll continue now. So, the idea what I'm trying to say is that how many of you resonate with the fact that too much importance on trade execution and too less importance, too much importance on risk reward and too less importance on risk reward. Both are incorrect. How many of you resonate? Keep your hands up or raise your hands. If you want, you can share some experience also. You've experienced, how many of you have experienced that focusing too much on the risk reward? Let me take a stop loss with ₹2. Let me take a small stop loss, a half a quarter% stop loss for positional trade, and let's see how it works out. Okay, a couple of you resonate with this, right? So what I'm trying to say is the technical strategies which I used in order to take a position, in order to execute a trade, to think of a trade, have their own ways of unfolding, have their own ways of setting up. The idea behind technical strategy is that not traders like you and me can move the markets. So we wait for the strategy and the pattern to unfold to be able to see what is the point where the mass tide of buying and selling will, make the price move to a good magnitude, in a good direction, in one direction, for a good period of time, and depending on whatever time period of trade you are taking. You can put your hands down now. Thank you. So, in this entire scenario, a lot of people do not understand the fact that if the pattern formation started at 100 rupees and it took about 20 rupees for the pattern to just form, they do not understand that it was imperatively good for them that they did not enter. And at 120 rupees, that pattern is giving you a signal to buy. And that time you don't look back and regret that I missed this at 100 rupees, because now you're buying when it is going up, right? So please understand this. This is very important. Little things make a big difference. Also, there may be one instance in which you took a trade and that suddenly worked out in a big way for you. You did not have to face much of a stop loss. You got the flow of the entire movement. You did not have to see the trade go against you, against your direction, in a position where you were losing money. It happened very smoothly and very promptly and spontaneously. So there was something trading at 2,000 rupees. At 1,950 rupees, you saw it giving a good signal. So it did something over there. Or probably forget the signal. At 2,000 rupees, you felt like it is not being able to go up. You shorted it right then, and immediately the time you shorted, it came down. And it was not just a small downward movement, it was the entire correction. It fell down by 200 rupees. It fell down 10%. You've thought very good of yourself. Gave yourself a pat on the back. And you thought that this will happen again and again and again. Least understanding that every movement was unique, every setup was unique, and everything you did the market will not respond to it the same way all the time. So now you have got addicted to a profit. You've now got addicted to a profit, in alignment with a very small stop loss, because they used a small stop loss and it worked out for you. So we'll discuss about this association and experience later. But what I'm trying to tell you is that every time the case is not the same, where you can get in with a very small stop loss and get out. The understanding of your movements and strategies is very important. I'm not saying I personally take trades where the risk reward ratio is significantly good. I'm not saying that you shouldn't do that. But all I'm trying to say is that you should understand what are the dynamics of price mechanism working behind it. Now, I use this anecdote very, very, very frequently. I would like to use it again today. I want to ask you, why do you think traders lose money? Why do we lose money? Why does the typical trader, the 95% of the trader, lose money? They lose money because of primarily two reasons. I was reading an article about the road traffic in a country and the accidents which happened with animals. The accidents which happened with animals and because of two animals. One was a dog and one was a donkey. Why dog? Have you ever seen a dog crossing the road? He is so indecisive. He doesn't know what is happening. Goes back and forth, back and forth. He sees a car coming from there, and then buy, sell, buy. Impulsive, easily stimulated, indecisive, and bang, accident. What happens with the donkey? Problem with the donkey is that he goes there in the middle of the road and he just stands. वो एक decision लेता है और उस decision के लिए गधा बन जाता है. You have to be very careful about this because this is a very common problem with people. You hold on to a stock too long You hold on to a trade too long, either on the winning side or on the losing side. Both are incorrect. So the truth, what is the truth? Should I not be flexible? But then you're talking about a dog who is very indecisive because of his flexibility. Or the donkey will come and say, should I not be holding on to trades? Otherwise, how will I capture a big rally or a big fall? The truth lies somewhere in between. And the extremes of these two virtues are both not healthy for you. The truth lies somewhere in between, and these two extremes both are not healthy for you. There are solutions to this. I'll tell you what they are. For a few reasons for incorrect execution of trades. How many of you really have felt, that at the end of the day, your strategy was right, your direction, your estimates, your anticipation was right, everything was just in place, but some way or the other, you did not execute the trade properly, and that execution error was everything that made you lose a winning trade. How many of you felt that? Can you raise your hands? A lot of you. A lot of you have felt that. A lot of you have felt that. So why is there exactly an execution error? What I have noticed till now is that there are very few specific reasons why these execution errors are there. And if anywhere you resonate with each of these points, anywhere you resonate with any experience, you can share with all of us. So point number one, the lack of understanding of price movement. Price doesn't go up and go down, just go up and just go down. 1,000 points, 10%, 20% up down doesn't happen every day. A 4% up down also does not happen every day. Every day the market has unique price movement. If somebody understands the price movement, they understand the fact that in different time cycles, they show similarity. And through those similarity, you have ideas, concepts, and variables. If you study them properly, you can also find the qualitative, the predictive quality of technical analysis and exploit that to make money. The stage of such clarity in technical analysis and the stage of very raw idea of price movement, as a person develops through, I see a lot of people who are hovering in the middle. What I mean to say is that they have a good understanding and synchronization with the market. They have a good intuition about what can happen and have good estimates. But they have extremely no idea about why they are entering a trade at a particular point of time. See, this is the problem. If you have an estimate of price movement, very good. It will help you. Definitely, you are good at it, and it's appreciable. It doesn't mean that if you don't know a subject in depth, you're a fool. You do know a lot of things. However, when you enter and exit a trade, a certain rationale behind what is your rationale behind your entry at that particular point? What is your rationale behind an exit of that particular point? What is it that you're looking for from the trade? If you're looking, when you people do a lot of things just for the money, it becomes 2 times more difficult to do it. Just think about it. If I were to go and tell you that go to a disco and dance with your friends at the age of 20, you would go and do it very happily. If I pay you right now, you find it difficult to go and dance on the stage. It is difficult. And that is where the shift starts from. That you're not doing it for the money, you're doing it to perform well, to express your ideas well. And if I were to tell you what an idea is, it is how well you can explain an estimate to yourself. So a lot of understanding of price movement in terms of estimates needs to be molded into particular ideas. Specificity should be there. You should know your directions. Secondly, poor trade selection. If there is anything I give a lot of time to, it is trade selection. And somebody asking me a question or sharing something. So Bibarish asks, how do you use trailing stop loss effectively after we made a certain amount of profit? That's a great question. That's a great question. I will answer this question. Hopefully also with an example. I'll get back to this question. We'll talk about it. It's a part of this content probably. Second is poor trade selection. And if I were to tell you what I give extreme importance to, I give extreme importance to very good trade selection. See, if you give importance to trade selection, 80% of your problems go away just like that. After that, it's a smooth ride. Trade selection is extremely, extremely important. Trade selection means, can you rate the quality of your trade by the rationals you are using for it? So whatever rationale I use to generate a trading idea, if I can rate the fact that this is a very high probability trade and the chances of it going way in my favor is very good, or it is a rare pattern or a rare occurrence which is very potent, which is very strong and has significance, obviously that gives me a certain ease to take the risk. It also gives me certain ease to take the bigger risks, because there will be some trades where you would want to allocate and take a bigger risk. Those will be those trades where you think the probability is high and the movement is going to be very big. So a good trade selection makes you go 2 steps ahead. You don't have to think about a lot of other things like monitoring the trade, letting or not letting a profits run, to be flexible about whether I'm right or wrong in the trade. A lot of people who take the mediocre trades are always in this humdrum and dilemma that am I right or am I wrong in this trade? If the price is not working out towards my direction, let me just square this trade off because I think I'm wrong. There are 2 reasons why people make these decisions and that dog sort of behavior which I spoke about. 2 reasons. One is they have no strategy, or if they have a strategy but they don't have a good entry. What do I mean by a strategy first? Your strategy has got nothing to do with how you read charts. Your strategy is just an idea on the basis of your reading at a particular point of time. If you mix chart reading with risk rewards and execution, that becomes a trading strategy. Having good trade selection really makes a big difference to your overall trading. One more thing which is very important is that it becomes a habit. A lot of people don't understand how important it is to generate the habit of taking very patiently well designed and proper high probability trades. That comes much in the earlier part, in the selection part of trading. Point number 3 is about the monitoring of trade. That is, after you have taken a trade, what is it that you do? What do you think? So suppose I took this trade, I bought something at 1,000 rupees, and I expect it to go to 1,050 or 1,100 rupees. I expect a decent move in my direction. It's fine, fair enough. What's the problem with this? If I start to sit in front of my screen like a junkie, I'm going to have a thought attack. How many of you have felt this thought attack? How many of you have felt this thought attack? This is one of the reasons why very well educated, well accomplished professionals find it difficult to trade. Because if something is not happening according to them, it makes it very disturbing experience. All your life, if you've been getting your 90s, believe me, it is a very difficult experience to see yourself getting a 60. Yes or no? It is a very difficult experience to see yourself wrong if you've been right all through. That point is the point you have to learn to let go. That point is got nothing at all to do with how well you're going to do, how much money you're going to make. That point is the point where you have to learn to let go. People find it difficult to let go. Over monitoring a trade makes you not just think, it makes you talk yourself out of very, very good trades. Sometimes it expands and overblows feelings of regret like anything. I wish I had bought more. I wish I had exited there. I wish I had done this. I wish I had done that. Even after closing the trade, some people monitor those trades. Oh, I could have got 25,000 rupees more. Oh, I could have done this. I wish I had not squared off my profits. Overblowing the regrets. Over monitoring the markets and over monitoring the trade when you are in the trade, over monitoring that trade. Both are incorrect. They also expand and overblow feelings like greed, feelings like fear. Let me add more to it. Or feelings of fear. What if I'm wrong? And then the price goes up and you tell yourself, what if I'm right? All this, don't you feel a little more Bollywoodish while you're monitoring a trade? If you feel a little more Bollywood-like when you're monitoring a trade, you're doing it wrong. As in, if you have got a good trade selection, 80% of this problem is solved. Because you are far more short-footed about your estimates. You have done your deep research, you have done your detailed research, you have taken the best trade. Now is your time to let go and let it unfold. Monitor your trade. It's not that you don't have to monitor your trade. Monitor your trade. But don't think about it too much. Personally, how it works out for me is whenever I take a trade, I've done the execution part, I've done the thinking part, and there's this part where I have to not think about it. I chat about the markets with my students. I read the charts for other trades. I look for other trading opportunities. Sometimes I move around. Basically, the time from 9 to 3:30, the market hours, I take that market hours just like a scorecard. The main work happens after and before the market hours, the planning work. Market hours are for money to make money for me, my money to work for me. If you take markets and trading in that spirit, but this is going to be far better. Now you may ask this question, you're asking us to monitor a trade, not so much, but what if it is an intraday trade? And I do take intraday trades myself also. Now the problem over here is, when it comes to intraday trades, I'm thinking about it. One very crucial thing is that intraday trades are going to close intraday and you don't have enough time for the market. So in a price chart, you have a lot of room in the price up and down y axis, but in the time of x axis there is a limit, there is a full stop if it's an intraday trade. You need to plan it well, you need to enter it well. But if you look at it very nicely and very clearly, it has the same dynamics as any other trade. So if I take an intraday trade, I put a stop loss and I relax. I monitor it only with the idea of the price coming in my favor, trending in my favor, be it a short or a long trade, giving it enough time and space as it needs to, and then closing it. Now, this is, I'm talking about a very smooth trade. Problem with intraday is that sometimes you'll have you bought a stock, it goes up, and then it is just staying there, and then it goes up, then it goes down, and it will not give you much money. Now, my question is, your estimates may have been good. How good was your strategy? How good was your estimate on the momentum and the time, the overall direction? How willing are you to understand the fact that there's a full stop in the timing part in intraday trades? If you're willing to understand that, it is easier for you to take that experience. The next day you take another trade, it really trends. You get 2% profit and you book out. It trends so strong that it becomes 5% profits, 8%, 10% profit. Why did you book out? Because yesterday you felt like, I wish I had booked out earlier. The two parts of the move are completely different. They led to completely different things. So here, both understanding of the markets and the price movement and good trade selection and monitoring the trade less, all three work. All three benefit you. So you see, each of these points which I am talking about, you can use in your favor. Fear and greed. Obviously, fear and greed, we all know. Fear and greed happen at two levels and two dimensions. One dimension is, how many of you remember the Brexit day? And on the day of Brexit, I did not have any previous position apart from positional trades. So those stop losses were not hit. But I had no positions in terms of FN. I took a small walk at about 10:30, 11. That's 2 hours after the market. And that day markets were dumping down. And I started thinking, I became very fearful in terms of what is going to happen now. I mean, I've never seen the market fall so badly in one day. Either it hits the the lower circuit and we get done with it, because that is understandable. But you have a lot of work happening or a lot of volumes, this, that. I was like, there's something. If someone who is not even holding a trade feels the fear of the fact that what can happen to the market, it's a very general thing. I'm not fearing that I'll lose my money or anything. It's just a very general thing. Then just imagine people who are holding on to long positions, taking long positions, or taking trades, or sitting in front of the screen. What may they be feeling? Extreme level of pessimism. That was a big catalyst for me to take that opposite side position and make money out of it. I didn't do it absolutely at the low, but I eventually made a lot of money after it bounced from there. So one dimension of greed and fear operates when people are just talking about markets. They don't even have a position. And market does move and does react to even those emotions, because a lot of those emotions are then acted upon in the same way. Sometimes it is greed. So when I speak about exuberance, what is exuberance? Exuberance is that state of mind where you don't perceive risk. because you're so sure that you start becoming greedy. Now people ask me, is greed good? Believe me, people who say that greed is not good end up being the most greedy people. If greed is not good, then why regret the fact that you lost 8% on a trade? If greed is not good, then why regret the fact that you lost big money on a trade? Think about it. The point is that there is greed and fear is nothing. It is just a perspective. It is just a perspective of where you see yourself, and the situation you will attract like a mirror reflection of yourself. The market is a mirror, it will give you what you feel. If you have the right methodology, it will give you the right money. If you act by emotion, it will give you more emotion to play around with. Experience and association. I think by now a lot of people understand what I'm trying to say with experience and association. I took 3 trades, and the second trade I lost big profits in terms of I was getting a lot of money, but then I was waiting for more money to come to me, and then it came down and I had to book less profits compared to what I was making. The third, the fourth, the fifth, sixth. Now each trade I want to wait for more profits to come to me. I'm not booking out fast because I'm associating it with my experience and just holding on to that experience. Whereas a lot of other things have happened in the market. The opposite of it is true also. Are you guys with me? How many of you understand what I'm trying to say with association of experience? Please raise your hands. I have one question. Okay. Yes. That's the whole idea. Now, a lot of people, and you know, when I say a lot of people, they, I talk about the major number of traders who lose money. It is sad. I'm very compassionate about it. I want to help people. When I say it in all humility to be able to express it theoretically. What I mean to really say is that these are not people. These are just consciousness. These are just trading habits and thinking thought process habits. How many of you have seen yourself in the more confident mode and the less confident mode in a matter of 1 month? Seen yourself at 2 extreme levels, performing at 2 extreme levels, thinking 2 extreme things, completely different selves. When you are in a mode, in a form, when I say you're in the zone or in the form, I basically mean to say that there is this mental space you have activated where you're thinking optimistically and your consciousness has become broader in size, more patient in understanding what are around, and you don't do it for the money, you're doing it just to perform well, just to dance the same walking style you have. And then there comes a time where you are not looking at it from that point of view. You have faced a drawdown. A 10 lakh rupee account has become a 7 lakh rupee account. You faced a downturn of 30%, that is 3 lakh rupees. It is money at the end of the day. The opportunities are similar. Everything is the same. But you're feeling something completely opposite of what you felt when you started out. How many of you have felt this? How many of you really have understood that your previous trades and your current trades are mutually exclusive to each other? All the more, they're not just mutually exclusive to each other, you thinking sadly about something at a different point of time, say for example during drawdowns, is not going to change anything about the trade. So basically, a drawdown, a drawdown is changing your emotion from here to here. You're completely changing your emotion. And what do you attract from that? What do you attract from that, I tell you, is you started from an account which was over here. It trickled down. With more fear, emotions, it goes further down. You know, you see a downtrend in your equity curve. That is not a happening situation. Instead, what you want is, you want to activate this man all the time. Alert, fast, decisive, optimistic. You want to activate that part of you. So the big question which I get from a lot of people who have lost money, they start with talking about their losses. If you take a walk in my shoes one day, and I really am appreciating and I feel myself very lucky to be in this situation. I don't regret it at all. But if you were taking a walk in my shoes, you will realize how badly sometimes people get eroded emotionally after losses. Because every day I have a very personal touch with my students, and someone or the other tells me that I lost this much money, and I lost this many lakh rupees, and I lost this much money, and I lost this much money. The first thing they start with is loss. Talking about it, thinking about it. How do you think they will not associate their future trades with it? If they do anything that will be associating their future trades with their past losses and drawdowns. Yes or no? How much do you think that is hampering the execution of the trade? How much of it do you think is hampering the different parts of the trade? The trade selection, the trade entry, the trade monitoring and exit. Your past is haunting each and every aspect of trade execution. How do you think, even if you get the best of the calls, as they say, and even if you get the best of the ideas, how do you think it is going to ever make you money if you don't execute it properly? A lot of people who know the fact that they have to be resilient and get back up from drawdowns also feel the same. They already have the qualities, the skill to decipher good movements in the markets. They also feel the same. Execution should not be mixed with emotion. Now I'm entering into the psychology part of it. Why execution should not be mixed with the emotion? We need to separate these two things. You don't just need to separate these two things in one instance. That means with one trade. Now, for example, if you take this one trade and that is this really beautiful something which you've experienced many times before, something you've traded many times, this pattern has formed and taken time and you've been tracking it, and there's a certain surge of price and there's a breakout and you enter the trade effortlessly. You enter the trade effortlessly. You call up your broker, you say buy 5 lots of this. You relax, you just relax. You just walk around your office or your house and that's it. The next day you know you're going to make money off it. That effortlessness, that no emotion, relaxed, chilled out way of doing it. That should not happen just on one trade. Because if you think you've got it right after one trade, you're thinking wrong. Then you're going to come into the zigzag mode, which I call. And believe me, I've faced it. I've gone through this. Right? How many of you understood the zigzag mode which I spoke about? That you need to keep this one throughout the series of trade. not just one trade. Being effortless in one obvious trade is easy. Being effortless and easy throughout your trading sessions across 20 trades, that is tough. How many of you are understanding what I'm saying? How many of you have faced this zigzag for a very long time or are facing a zigzag? Right? Because you have got a lot of elements which are required, but there are certain missing, filling in the blanks which need to be done. You have got a lot of elements which are required. So tell me from a business point of view, if you have 20 trades, and by the second or the third trade, irrespective of profit or losses or irrespective of the quality of trades, by the second or third trade, you are losing the form and you have started thinking about what if I lose the money which I have. Suppose you made 10,000 rupees in the first trade, another 15,000 rupees in the next trade. You have 25,000 rupees. Now you have the fear of taking a bad trade because you might just lose a lot of what you made. So by the third trade, your flow is getting over. How many of you face something like that? Maybe not the third trade, maybe the second trade, maybe the fifth trade, eighth trade, whatever, out of 20. Do you think from a business point of view that if you have the tendency to stumble anywhere in the middle of your series of trades, it is a good business decision to keep trading? Because you know for a fact that maybe it is not just one or two trades where you will, you will stumble. It will just take one accident for you to go one step down or one step again in the zigzag. Muhammad ji says he always faces this. That's very humble of you to say, Muhammad ji. That is the first step. You have to accept it. Accept it that if I have a series of 20 trades, I'll just choose a different pen color. 1 second. Yeah. So if I have a series of 20 trades, and this is how my equity curve goes. I start from 0. I make some money. First, second, third trade. Then I have a drawdown. Somehow I gather some muster confidence up. But I still fear that if I'll be able to go higher, that fear again takes me down. I take a few days break. And I come out somehow, I come back again up. I feel too good about myself. And then I come again down. I feel too good again here. So every time I come here, I'm resisting to go up because I feel too good about myself. That arrogance is pulling me down. One bad trade and the whole plan is gone. That's what Kamlesh also mentions. So over here, this part of it has happened. Why? I had a friend who once took about 3 trades and he made 2 rupees, for example, in each trade. And then he took a loss on one trade where he lost 10 rupees. Did he think about the risk reward? No. He just thought about making money. If you think about making money, you'll just make money. And there will be one instance where you'll not be okay with making money because you will be losing. And you might lose more money. You've not seen the psychological or the cognitive aspects of it. So a lot of people I come across have faced this sideways time, and they're extremely intelligent people. These are not the people who are super, the category I said, the perfectionist category. They understand that there's a lot of things, and they have those elements and forms. So every time they come from here to here, that element comes in, that form comes in. From here to here again, that form comes in. But there are things that are taking them down. Right? So I'm just trying to cut open what those possible things are that are taking you down. And to start with is the realization of the fact why you're going sideways. You're going sideways not because you can take one trade well and take another trade well. You're going sideways because every once in a while, in between, you become fearful and you stumble. And then you gather yourself up and again you stumble. You become arrogant and exuberant, again you stumble. I have faced this for a very long time. First I was facing this. Then I faced this. And then came a point of what an exponential rise. It is you. It is you who has to understand this. It is you who needs to make up your mind and move towards what profitable trading can be, what consistently profitable trading can be. I'm not even talking about profitable trade. I'm talking about a consistently profitable trader. That's what you want to become, right? That is all I'm coming from. It has got nothing to do with anything else. It has everything to do with consistency. And the consistency is made up of a series of trades which needs to be executed well. And that is how we'll find consistency. There's a very deep aspect to it. When I started out, it was very difficult for me to hold on to good trades. Very difficult for me. I was a very young person. I got into meditation. I got into things to calm my mind down. I started finding creative solutions to my problems. I started writing down my problems. I started looking at the pattern of my problems and patterns in everything else. I started accepting my problems and my weaknesses. And I began to change them. Yes, Kamlesh says that fear of losing the gains, makes them feel jittery. Kamlesh also says this. That makes a lot of sense. And I've gone through this. But there is a way out. There is a way out. I'll tell you how it happens. Focus on step by step. What I'm going to point out in front of the screen right now is going to be very simple. But to be able to take a step at a time and get into the flow of doing it repeatedly. That is what is going to take some practice. And for those who are still here, who have not given up, and who understand that with trading, 1 or 2 years is short term. 1 or 2 years is short term with trading. And who understand the long term and understand that they have to pay their dues and go through those struggles which are going to make the reward worth it. They will come out victorious. Just find out 4 or 5 different things. Very simple. First of all, simplify trading. Simplify. Simplify trading and trade execution in steps. One being trade selection. If you just focus on trade selection for some time, just give extra focus on trade selection. Super extra focus. Make it a habit. Make it a habit to have excellent selection of trades. Just give it super duper focus. Such focus that you would never give before. Trade selection. And I'll tell you what will happen. Your first streak will come more easily and properly. More smoothly. First streak of profits. But just focusing on trade selection. So if you've taken one problem, found the solution at a time, very good. The possible problems for trade selection can be a very technical discussion and can be very individualistically different for everyone. So we'll not get into that. So just to give a few examples, trade selection for somebody may be just looking back at his trades and say, I will kind of trade against the trend, but it doesn't work out for me. So I'll stop doing that. What works, the trades which work out better for me are the trades in which I'm with the trend. Okay, so that is trade selection. Number 2, trade selection. When I know that I am in a good trade, I feel confident about it. I feel confident about taking it. Good trade selection. when I can see these variables, I'm good at saying and I know what they mean at these points of time, I find these trade selection good. So how trade selection happens is basically you take 10 variables, 10 concepts or 7 concepts or whatever, maybe 4 for some people. You know, take those things, and you give yourself a subjective tick mark on this, or you can make an Excel sheet also. Okay, so weekly charts 9 out of 10, daily charts 8 out of 10, hourly going sideways, so maybe suppose it is a trade on the short side, so sharply falling weekly chart, very good. Is there a pullback? Give yourself a rating on how the and use all these factors together to put them together and rate your trade. That time you will feel confident about it. Give that extra focus on trade selection. Once you've given this extra focus on trade selection, you will realize that you have grown leaps and bounds in terms of confidence. Then I'm not sure about the sideways people. They will obviously do well. I'm not sure about how they will not do well. I'm more than that. I'm very confident about people who are facing a downward sloping equity curve. I'm even confident about them because with extra focus on trade selection, they will have the inner confidence that no matter how down they are, they can anytime come up because they know how to select a good trade. And the ones who are going sideways, now they will say, if I'm selecting good trades, that means I'm coming here. When it took me 10 days to come over here, now it is going to take me lesser time or more smoothness to come over here. See, if something goes in a crooked manner up, it takes a resistance. You will see something which is going up with full force. There will be a higher chance of breaking that resistance. But at this point something happens. That is something you have to read crucially in the price. If you can read crucially what is happening in yourself, you have made amazing progress. Second is trade entry. Here trade entry, a lot of it comes under trade selection also in terms of risk reward. But when I talk about trade entry, I talk about the spontaneity and I talk about the patience. So for example, I had to buy this stock which I was hovering about 200 rupees and 205 rupees. So 200 and 205 rupees it was hovering. Every time it went to 200, 205, if you feel like you want to buy it, you buy it and then don't think about it. Just do spontaneously. Or you are the kind of person where you have selected a particular trade, where you have a rough estimate that I'm going to get into the I 200 instead of 205, I'm going to get it 5% less at 200 rupees. So I'll just wait within that pattern and within that phase of the movement. I will just buy it at a lower level. And that time I will not fear that, oh, I may be wrong, oh, it may go 10 rupees more down and all that. So I'm talking about doing things without hesitation. When you focus on trade entry, become unhesitant and just do what you have to do, the right thing at the right time. Just do it and don't think about it. Just get on with it. Trade selection mixed with good trade entry, half the battle is won. Now the word battle, I will say very carefully that there are many battles in a war. So if there is a war, you must choose each and every battle very wisely. So choose your battles wisely over here. Get on with it. Now it comes to this part. Trade monitoring. So I will couple trade monitoring and exit very nicely. This is a major area of people who understand probabilities, stop losses, and still take good trades. Yet, there is an estimate and there is a chance of not doing very well. Kamlesh ji asks, what about timing of entry into a fresh trade? With a fresh trade, I did not understand. There is a fresh trade, and you want to enter that trade. So, for example, there was a stock which was at 1,000 rupees. I wanted to buy it, thinking that my stop loss is 1,080 rupees and my target is 1,050 rupees, right? So, at 1,000 rupees, I want to buy it. So I'll just go and buy it at 1,000 rupees. So that for me is a fresh trade. If my risk to reward ratio is clear, it is good. I'll just go and do what is needed. That's what I'm saying. What more do you mean by fresh trade? I did not understand. Okay, so you're talking about the fresh day. Okay, so how to take a trade at the opening or 20 minutes of the market open, etc. So this is a very important thing. Please understand that each one's style, everybody has a different kind of style and different variables they're looking at. I know some people and myself also. If suppose there is a breakout or there's a gap up opening or it is coupled with a larger signal. So for example, if something is told me that the moment it goes above 1,025, it is a buy. And I'm looking for 1,100 as my target and my 1,000 rupees as my stop loss. So if at the opening I get 1,030 rupees also and I want to buy it, I will buy it. My risk to reward is fine. However, if I'm taking a purely fresh intraday trade, then I will have, for that day, I will have the markets to give some time to the market to give me a short-term signal. So that is why a lot of intraday or good professional traders, either they take trades immediately at the morning, focusing on the larger picture and aligning their chart estimates with the bigger picture, the daily charts and the hourly charts, or in some cases they wait for about 10 to 20 minutes or about half an hour, 1 hour. I myself wait for a good 1 hour many times before I take an intraday trade, so that the setup has happened in intraday. Another thing people do, and I myself do sometimes, is when there are certain very good levels which I have already thought of exactly what I will do at that level. That time I take that trade even if it is just 5 minutes into the market hours. So it is a very situational thing. So at that time, you have to be very sure about what you're looking at. If you are looking at a bigger picture, then you can take a trade depending on your bigger picture risk reward, and it's a positional trade, even if you're taking it during the day or at the beginning of the day. But if you're looking at for an intraday, you have to give the time for some setup to happen in intraday. You have to give that time. If you can give that time, that is one step closer towards a better intraday trade selection. Sometimes you have to give not just a time for a flat and a opposite direction setup to happen. Sometimes you have to wait for the trend to happen also. So in the intraday, if something opened at 1,000 rupees, and as I said, as it goes above 1,025, I would want to buy it. So it opened at 1,000, and it went all the way to 1,025. So I bought it when it was already up 2.5% during the day. But I'm okay with it because my trading signal was there. So is it before or the gap up open, or is it during the day? It doesn't matter to me. It's a positional trade. So you do it in accordance with the trade design, not according to when you feel like trading or when you think it is important for you to buy it. If it is important in the terms of trade design, do it then, and do it unhesitatingly. Also, if you think you can wait for some better risk reward, then give it time. Wait for better risk reward. Your strategy will tell you if better risk rewards are likely to come or not. Also, so trade monitoring and exit. Trade monitoring and exit can be coupled together. How many of you think that sometimes stop losses and trade exiting becomes like a nervous 90s in cricket? You have to realize trading is not your nervous 90s. Absolutely not. It is not your nervous 90s. You don't have to feel too much if it is coming close to your stop loss. Because, for example, there may be a trade which for 2 weeks may be just not touching your stop loss, going up above from that. If it is a buy side trade, and after 2 weeks it start moving. On the other hand, a lot of time you will not take the trade only, waiting for the good entry because it is coming close to your stop loss. To be able to select a good trade, rules that problem out, and when you enter a trade, you can enter it in between also, and you can enter it when it starts going up. Obviously, if it's a buy trade, after a little fall, it improves your risk reward. But you cannot overtime the market is what you have to realize. If you realize in the stage of trade monitoring that you cannot overtime the market, you are 10 steps ahead in monitoring the trade. You cannot overtime the market. You have to time the market to some extent. You cannot overtime it. If you realize this, you're 10 steps ahead. Agreed? After you've monitored your trade, either it is moving towards your stop loss or your target. As long as it is moving towards your stop loss, stop your brain right there. Never change your stop loss. Some people with experience will understand that this strategy is not working out. That time it is okay. That time it is okay to break the rule and stop out before. But that you do when you are an expert, because you don't break the rules before that. Beside that, if a trade is giving you profits, making you significant money, how to exit it? Here I'll also answer Viparish's question on how to use trailing stop losses. No, it's a very funny situation, I'm telling you. Somewhere I saw a written, and I see this written, buy at 90 rupees, first target 110, second target 130, third target 150. You know, I've met a lot of people and I've gone through a lot of kind of things people do. I will be very obvious and curt with it. All those who make these 90, 30, 110, 150, if it goes to any of these levels, they'll come and blow their trumpet. That is all they're going to do. It doesn't happen like that practically in trading. Agree or disagree? Can you think of 4 exit levels when you're entering from one entry level? We need to shaft out what is practical. Now coming to the trailing stop loss part. What you can do is that if a trade is making a lot of money, there are 2 ways of looking at trading stop loss. One is, say, a series of higher highs and higher lows, and you have bought into the trade. So at this point, when I'm making sufficient money, or maybe I've crossed my target already, my estimate of the trade, that time I'll use the last lower low, last higher low or this higher low as a point where I would want to stop out from the trade. Because until then I want to follow the trend. I'm following the trend here, and with a stop loss of this, it moves more in my favor. again it dips. Now my stop loss is this, then my stop loss is this, and whenever it turns around, I get stop loss. That is one way of looking at trailing stop loss. Another way of looking at trailing stop loss is the non-technical way. That is, if my target was to make about 8,000 rupees per lot in a trade, okay, and I'm suddenly making 10,000 in a trade. It's working out more for me now, and it's trending, right? Or forget my estimate of 8,000. It's just making me 10,000. I'd say intraday trade, and I know that in general you don't get such trades, you know, in the particular stock I'm trading or Nifty or index I'm trading, whatever. So I'm making 10,000. Now the moment that 8,000, 10,000 becomes 6,000 or 7,000, I have to exit the trade. That is my preconceived decision. Either I book out now and let it trend, or the moment that 10 becomes 8,000, I want to book out. Or if a trade in which you have seen a significant profit, I'm not talking about 500,000 rupees here and there on a lot, or 2,000 rupees here and there on a lot. If you made a significant profit, like say 18,000 rupees, okay, and then it dumps, it really dumps, and for some reason you did not book out. It's dumping and now it has become zero. Don't let it become minus. At least you can do that. At least you can not lose money on a trade in which you are significantly making money. Or even better, when you see a fall, keep a this thing of 50% in significant amount case. Don't sit in the hope that this will again go up and work out for me. Unless it is completely planned from beforehand, it's different. But if it is about money management, then these are the little money management nuggets. I hope this trailing stop loss thing is answered, Viparish. I hope it is clear what I'm trying to say. There can be two ways you can look at trailing stop loss. One is technically, one is, so looking at trailing stop loss is much better way of trading than looking at 10,000 targets. I'll buy 90, I'll sell it at 110, I'll hold on to, or maybe I'll hold on to 150 also. It doesn't work like that. You can do one more thing. You can scale down. So at a certain point where you're making significant money, you have closed half your position. Now you've booked so much profits on half your position. Now the rest half, you can let it run. That makes sense. That is scaling down. What is scaling up? Scaling up happens in certain cases. Suppose this is price range. This is a very strong resistance point which has not been broken out for months. And in this price range, I have bought at the lower levels. You can view it as an hourly chart also, no problem. You can view it as a daily chart also. Think as you want to, get the idea right. I have bought at the lower end of the range. Thinking by the higher end of the range, I want to exit. But for example, like I use elliott wave theory, so I do wave counts. My wave counts, wave structures, and everything tells me that the breakout is likely to happen, and I hold on to it, and the breakout happens. You know, if the breakout happens, on the way, I will add more to it. This is simply scaling up. So I've doubled my position over here, and now I'm enjoying the ride. So is there anything wrong to add more to the risk exposure? When you're convinced, when it's a fresh signal, then you look at it in the entirety. You look at these two trades, these two positions, you add them up, say 100 shares and 100 shares. Now you look at 200 shares and you look at your average costing like this. And I can conveniently put my cost as stop loss because this is an additional signal. So when you're scaling down from an existing signal. When you're scaling up into an additional signal, most probably more powerful. But don't let yourself lose a lot of money on a trade which is making money. Also, the most crucial point, which I also mentioned in the WhatsApp group. For example, let's say it was a fresh trade item. Okay. There was a range. I'm just not getting too much into technical things. Just a simple range breakout. Okay, it's broken out. Okay. Now suppose this is the 15-minute chart. This is the 15-minute chart, or this is the hourly chart, and I bought it during say 11 o'clock or 10:30. Nifty did this, and I bought it, and I'm holding on. Or probably just capture the price point from here. It goes up, it goes sideways for the next 3 hours. But it's been quite a breakout, so I'll just hold on. If it's on the hourly chart, it's understandable. I can understand that these dips are coming, and I can understand that these dips will come, and this is how the mechanism of price is. It just doesn't go up and keep going up. It has its corrections and digestions. But if this is the daily chart, and I have already enjoyed a 600-700 point, 800 point rally, or maybe a 300 point rally also. If it is a daily chart, the volatility increases with the expansion of prices. Often trading strategy, whether you're aware of it or not, they include this expansion of prices. And the volatility increases. Now every correction is also 100 points. So sitting through a 300 point profit and seeing a 100 point correction, that is not so viable as thinking of a 30 point profit and seeing a 10 point correction and then seeing another 30 point profit ahead. This is total 60 points to be taken over here. Here maybe 600 points are taken. But when did I enter? I entered and I got 300 points in a day. Here 30 points were to be made. I did not exit. I could wait for 60. Here I got 300 points. Now a lot of excellent people in technical analysis also don't understand this. Myself being someone who had this habit of holding on to it, I will get 600. And I don't realize that the weekly chart and the daily chart and the correction will also take 2 weeks. So 2 weeks I'm holding on, 3 weeks I'm holding on, or not so long, maybe 2 weeks only. But I could have booked out in 2 days with 300 points profit because my stop loss was very negligible. How many people are understanding it is important sometimes to book out your profits at the first impulse, even if the trend is up, without any regrets? How many of you are understanding what I'm saying? Don't regret. Use this momentum, use the profits you're making into getting more stability in your equity curve, creating and not regretting and looking at it later, and again booking out profits when you're getting significant money the next time. The more profits you book, the more stability you increase. The more losses you book, the more losses you have, the more drawdowns you increase. Agree or disagree? Any questions till now, whatever we did? Because today's session has this much, and we're going to go ahead with. Right? Agree? Any questions? No? So this was a lot about trading execution today. So it'll be very easy to be that successful, optimistic trader. I'll take a small idea from the Vedic law. I forget the exact term, so I will not say it right now. But this is the part of my recent research. It has to do with one of the nakshatras. That there are two things. One is the bad feeling and despair of not having success, and the other is joy of success. To be able to come out, you have to be determined enough to get over, strive through, and no matter what, gather the perseverance, the resilience to go through and come back up from the bad feeling of despair so that you can enjoy the good feeling of joy of success. Kumarji, I just saw your point. I would like to take this up sometime. Uh, this is a self-sabotaging belief. Let's not think in that way. Kumarji just mentioned that in stock market, our success is somebody else's loss. We have to understand that this is an open exchange and somebody may be just hedging their futures position. Somebody may be hedging their future position. We may be buying. Somebody may be selling 3 days later. Somebody may be selling at a profit. Five trading sessions later, where we profited from that. So there is an exchange of contracts over here in an open exchange. Don't look at it in a negative way. As traders, when people come and ask me, what do you create as a trader? Fine, teacher is fine, okay. Giving an impact to the society. What do you create as a trader? We create the liquidity for the capital formation in this country. Without traders, there will be no capital formation. We create and provide the liquidity for the capital formation. Right? So there is a social idea. Do you know how many people we are not even aware of? But I meet these people every day. I mean, obviously I meet a lot of traders. There are a lot of people in the finance industry who are surviving and having jobs because of all this liquidity. So there is an entire ecosystem out there. So let's not take it like that and think of it positively. It is always positively. You don't even need to think about it. It's about the long-term habit, guys. It is about the daily lifestyle habits. It is about the profit-taking habits. It is about how you sit through the trades. And the most important thing, how you can forget about the regrets and do it every day. Self-motivate yourself every day. Get out from those lows as if you were doing it every day, and it will become a habit. This is myself, Mohit Pachesia, and I run a course which is called Technically Sorted. That is apart from these initiatives that we take. And this is a paid course, a complete course from a very basic level to a very advanced level in technical analysis. Some of the people over here are already my students present in this webinar, and some are not. However, there are a lot of people who have benefited from this course, and anybody from someone who's just freshly passed out from class 12 to a retired person can join in. We include all aspects of equity research in terms of technical analysis and in terms of trading wisdom and trading psychology. There are a lot of other YouTube videos you can benefit from. And to be able to, if you want to know more about the course or want to join the course, you can contact our course coordinator, Ashish Dalmia, or if you want, you can contact myself. The course structure, content, fee structure, everything will be told to you. It's a 15-session course with 2 to 2.5 hour classes on weekend, every weekend. So it runs for long. And beside all this, you have many more additional things, a very active discussion group, and a lot of past students, new students coming together after the course. So all of this is happening, and we look at it in a very real perspective. To be honest, today, whatever we did, at the end of the webinar, the initiative started very early. Back in my city, we started with a few seminars, which we paid for, which was, yielding nothing in terms of teaching. But teaching as a business model is not the primary motive. The primary motive is to be able to create an impact and get the real perspective into people's minds when it comes to trading. So from those days where there were actually no students, all the way to having seminars, a lot of other places in India, online in webinars, and having students, consistent matches throughout this. If now anybody who is attending a webinar or a class session in the course, please justify all these efforts and motivations by actually applying what you learned today. that is going to give me more satisfaction than anything else. So thank you everyone. And as the quote goes today, generally I don't pick this up, but as the quote goes today, which is there on this slide, the hand you choose to fold and not the hand you choose to play determine your trading success. Thank you so much. If you have any questions, you can ask me. I'll be logging out now. So if you have any questions, you can ask. Okay, guys. Thank you so much, Kumarji. Thank you, everybody, for being here. Take care. Have a good trading week and keep in touch. It was great. And since I have a class exactly in another 5 minutes, so I will take your leave and have a good weekend also. Bye bye, everybody.